Hi and good morning and welcome everybody to our webinar Into the Wild. My name is Mona and I'll be your moderator for this session. And we are glad that so many of you are joining us as we discuss the risks and trends shaping 2025. And before we get started, I would like to share some practical information with you. So the webinar will run for approximately 1 hour. The presentation and the recording will be made available for you after the webinar. And we encourage you to ask questions throughout the webinar. So you can do so by clicking on that little question mark on the top of your screen, and you type in your question and you send it to us. And we have a dedicated Q&A session at the end of the webinar where the panel will answer as many questions as they can. So today we have a great lineup of speakers from COFAS who will share their insights with you. So first out is our CEO for COFAS Nordic, Pekka Putonen, who will have a short introduction and set the stage for today's discussions. And then you will meet Jonathan Stenberg, the economist for COFAS Nordics, and he will go through the presentation Into the Wild. And then we have Arnfinn Løv Mikkelsen, which is a senior risk underwriter, and he will share the underwriting perspective for today. And without further delay, so I will hand it over to you, Pekka. Stage is yours.
Very good. I hope the connections are working. Good morning, everyone, and welcome. Indeed, it's an April Fool's Day. However, we have a lot of interesting content to cover today, and for very good reason. I think the first quarter of the year that ended yesterday has been one of the let's say, busiest ones we have seen in our industry or our clients have experienced. The vast amount of news feed coming from different pockets of the world, primarily and mainly talking today from US, and the way the global free trade has been shaped up by the continuous stream of tariff announcements, counter tariff moves, tit for tat. We probably should consider the terminology of trade war fairly soon, if not already. But we decided to take a little bit of a bet today and placing the webinar on 1st of April, knowing that tomorrow will be a day that everybody will be following very closely. It is called a Liberation Day by the US president, where we are expecting to see quite a lineup of announcements. We will discuss this later in this call by Jonathan. But these things, these announcements, these are factual events that will take in place that will add cost to trade, friction to trade, and in fact, already today, the level of barriers to trade in terms of tariffs or import taxes, etc., have taken the US approach to the global Western trade back to the 1920s. So we're talking about a shift that is significant, both in relative and absolute terms. And what comes tomorrow might be a historical moment in the essence that we haven't witnessed such total cost for trade from the US or to US, never in the history of measuring such levels. So this is something that we will be eyeballing a lot, obviously, because it has impacts to Europe, it has impacts to our trading nations in Asia, it has a complete global causality stream, which is not always very clear. And this is something that we have been discussing a lot with our clients, existing, new ones, how to tackle this, what should we look at, how to factor this in. And it's a fairly good question. 4 years as we expect today. Who knows what happens, honestly speaking, in the US? It's a fairly short period of time to start changing drastically some investment plans to nearshore manufacturing in the US rather than having it in Europe, or finding alternative trading paths into that end destination. It's causing a lot of questions, and these are some of the topics that we try to give a little bit more light today. But what is absolutely clear is that geopolitics, trade, war as a part of geopolitics, and just general shift in the world is becoming less, let's say, predictable. It will be less globalized in an essence of having that alignment across the countries on how prosperity is being built, meaning that the less friction we have in trade, the better off everyone will be. This is probably something that we will witness, that the direction is contrary to that. But all that in mind, of course, Europe has taken quite of a stance as well. We've witnessed something pretty historical from Germany, which will have positive impact. Jonathan will cover this one as well. But the fact is that Germany is stepping up with their historical physical stimulus package that effectively has no lid even, will be supporting the European economy, of course, primarily the German, but it will have spillover effect. So in all of this, there is something good, there is something bad, and there is something ugly. And that's a little bit what Jonathan will be talking about in a few minutes. But I will shut down here now and follow the webinar. I hope you enjoy. Make as many questions. Be active. At the end, Arfin will cover some more detailed items about some specific sectors, findings from Boston, and then we'll have a Q&A, and I hope to see as many questions as possible. Over to you, Jonathan.
Perfect. I will need to be allowed to share my screen.
I think you should be allowed now, Jonathan. Oh, here you go.
Perfect. Then there we go. You should be able to see my screen now. Perfect. Yeah, so again, today we'll be covering a lot of different things. There are so many topics to discuss that I might power through some of these slides to be completely honest, but you'll be able to get them afterwards. And we just want to make sure that you get as much information as you can. But yeah, I might go quickly through some of them, and if there's some questions in the end that you want something elaborated on, don't hold back and please ask us. So as you hopefully know, we update our country risk assessment map every 4th month. This is the latest update from February. Next one's coming in June. I won't go into too much details because while a lot is happening in the world, this was, relatively speaking, we didn't see the most changes in our country risk assessments. We were relatively comfortable in most places with the assessments as they were. We did see a few upgrades. That includes Oman, Guyana, Luxembourg, and the UK. I won't go into too much details there, but just say the Luxembourg economy is doing better. It's helped by a bit of a stronger banking sector and some more strength in the European banking sector as well. The UK is more, I'd say, brought back into an A3, which is aligned with several other European, Western and Northern European countries, whereas we felt that at this point an A4 was no longer appropriate. And then we saw some downgrades in Botswana, the Maldives, and Bangladesh, and to a large degree these are idiosyncratic, but I think an overall thing can also be to say that the strengthening in the dollar is hurting emerging economies, and it's something that we're definitely also seeing here with some of these countries having a hard time honoring their debt. But to sort of get straight into the main topic of today, which is Trump, it's just that reminding ourselves of where we are, and how severe this is, and what we we expect to be seeing in the coming months and towards the end of this year. So just to recap, we have seen at 20% tariffs on China introduced in two different brackets on top of what there was beforehand. We saw some threats of 25% tariffs on Canada and Mexico, 10% on oil. Some of these were taken back, and exemptions were made on any goods that is compliant with the USMCA. Again, just to remind people, that is a trade deal that Trump made himself, which is always ironic once he complains that it's not a good enough deal. But goods that comply with this were exempt until 2nd of April, so tomorrow. We still have not gotten an update whether or not that will change or whether or not that will continue to be there. And then obviously the global tariffs on steel and aluminium came into force from 12th of March. And we have now also gotten the announcement that there will be a similar global tariffs on automotives, not just complete vehicles, but also parts and components. So these are some of the different announcements that we have either seen being implemented or has been announced. And then there's also the threats, the rest. But just to put this into perspective, and I think Pekka already alluded to this, if you look on the right-hand side, if we combine the tariffs on China, Mexico, and Canada, and the global tariffs on steel and aluminium, then we are looking at a world in which we are more or less back to the late 40s for the average tariff on imports for the US. If there is no exemption on USMCA compliant goods on Canada and Mexico from 2nd April, if he introduces something like a 25% tariff on EU goods, we're not saying necessarily will, but just put that sort of into perspective, then we would be looking at the highest tariff level since basically since the Great Depression in the US. So that's back in the 2030s. So these are very serious numbers. These are very serious threats. We want to highlight what we're probably looking at in the next few months, and by making a certain distinction. He's been talking a lot about reciprocal tariffs and sector tariffs, and these are two different kind of things, and we want to highlight that fact that what we're seeing tomorrow will be the result of their investigations into reciprocal tariffs. What we probably will also see, initially he announced that this would also be in April. It has been somewhat pushed back, but that'll also be on sectors as well, and I'll get to that in a second. But from tomorrow, this will be the investigation on reciprocal, so that'll be focused on countries and or regions, like for example the EU. He has made it quite clear that he won't just include direct tariffs, but also what he calls indirect tariffs here. So that could be changes in rules, in legislation that makes it harder to export, but also includes stuff like differences in VAT compared to what there is in the US, despite the fact that that has nothing to do with trade, I might add. But he will include things like, for example, if he believes there are rules on agricultural products in the EU that he believes are unfair, he could maybe say that qualifies as a non-tariff, but something unfair. He could include the taxes on big tech, saying those are specifically targeting US companies, which to a large degree you could argue that they do. In addition to normal differences in tariffs. To sort of put that into to quantify it, there is a small difference if you compare goods going towards the US versus towards the EU. You probably could find, depending on how you weigh it, around 2 to 3% difference, which means you could add 2 to 3% from the US point of view and say that would make it, roughly speaking, reciprocal. But our impression from what he's saying is that he is planning to include these other factors, potentially also just to a certain degree to have a nicer, bigger number to put out there. And our expectation is that he will be putting up tariffs towards the EU. We're not necessarily sure it will be up towards 25%, but with his rhetoric, with his general impression, it seems like he does perceive the EU as a competitor to the US, we do believe that he will introduce some tariffs towards the EU to a larger degree than he did the last time. One of the things to also keep in mind is that the most vulnerable countries to these reciprocal tariffs will be emerging economies. So while the EU will be, as we said, probably affected to a large degree, countries such as India, as Indonesia, some other Southeast Asian countries, and some Latin American ones as well, do see very big differences in tariff rates. That is not uncommon. In sort of the global order, we accepted a few decades ago that emerging economies were allowed to have lower tariffs than advanced economies so they could develop their manufacturing sector. But if you look at somewhere like India, for example, they have already made a lot of concessions because the average tariff difference for example, automotives was about 100%. And that is something that you obviously would have a big impact on the country if he was to do a reciprocal tariff. So this is just to say on the first point, we do believe he's very serious. This will be mainly focused on countries and regions to start with. Then there's a second part of this, which is the sectorial ones. So that is stuff like what he's done for steel and aluminium, what he's threatened to do with automotives from the 2nd of April, which are not focused on regions, these are focused on products. We know that he has talked about previously some agricultural products here. We don't know specifically yet what these will entail, but that is one of the things he's looking at. He has also mentioned investigations 232 on copper imports, potential timber lumber, and other derivatives. So that's something that would hit the Scandinavian wood exporters potentially. And we also know that he has been talking about potentially looking at semiconductors and pharmaceuticals. However, there does seem to be a recognition within his administration that semiconductors and pharmaceuticals would be one that is difficult to implement very quickly. And you could potentially see him using that more as a negotiation, saying, in the longer term, we want to do this, but if you promise to increase manufacturing investment, we might postpone it somewhat. This also leads me to the very salient question of, is he serious? Is this just a negotiation tactic, or is there something more to it? There are many disagreements around this, but we fundamentally do believe that Trump wants more things produced in the US. He wants it to have a stronger supply chain resilience. He wants it to strengthen the US manufacturing base again. It's something he's always sort of stood by, but it potentially seems like maybe COVID actually made him realize the vulnerability of the US, and that is something that he has taken serious. So while we do believe some of these things might more be used as negotiation tools, we do think that the overall headline is that he would want to bring back more manufacturing, which means some of these are there to stay because he fundamentally believes the US should be producing more of these things. We are slowly and gradually moving towards a trade war, and there's been different levels of responses so far. If you look at somewhere like Canada, they have gone into this trade war full throttle, to be honest, with quite high values. And what you need to keep in mind is the fact that Canada actually has a lot of strength here. What you need to keep in mind is that Canada is actually a massive importer of US goods. If you did not include the oil that Canada exports to the US, they actually had a massive trade deficit with the US. It's just the oil that brings it into a surplus from their point of view. So they actually they have a lot of say. And when they add tariffs on the US, that is a big consumer base that suddenly is disincentivized from buying US goods. So Canada has also had the strength to go into this and saying, no, we mean business here. And as you can see, initially they added 25% tariffs on roughly speaking 21 billion goods. They increased that threat during the second threat, and they are saying that if all the tariffs are implemented from the 22nd of April, they will increase this to roughly speaking 87 billion additional goods. So Canada means business when it comes to this trade war. If the US goes all in, they're ready to go all in as well. China has taken a slightly different approach. They are a lot more aggressive than they were last time. They have increased tariffs on some of the things that really hurt the US. So the US are massive exporters of energy, oil, and natural gas and coal. They do ship a lot of that to China. They are also big exporters of agricultural goods to China, especially their soy exports is a very important business for them. And as you can see, China has gone all in here and included the tariffs on those. In value terms, these are lower than what the US have implemented, so China has not gone in as aggressive. And we'd also argue that they have a potential of introducing export controls, so the reverse, on certain things that would really hit the US economy. And that is, again, that China is such a key part of production and processing of some key minerals and metals, in which if they were to introduce export controls on these to the US, that would have a massive impact. Mexico has so far been silent on what their reciprocal retaliatory measures will be, and the EU were initially a bit more aggressive, but have somewhat stepped back, and current threats include 26 billion of tariffs. That includes the ones that we used to have. So those were the whiskey, the motorcycles, the steel, aluminium, and jeans from the US, but also included some new ones, which is further agricultural products, some wood, some metal products, believing these will probably be reciprocal. However, if there is an increase in tariffs coming tomorrow, as we believe there is, we would expect the EU to step up with further retaliatory measures here. So again, we are looking at the beginning of a trade war here, where Canada, I think, is on the front line as the most aggressive one, whereas China and the EU, for the time being, has held back a bit more. But let's see what happens after Liberation Day. If the US go in as hard as they seemingly might be, we would imagine China and the EU step up further. Which sectors are the most sensitive here? I've included here a heat map of sort of some of the key European states in the EU, as well as the Nordics. Basically, the higher, the redder it is, the bigger share of export to the US is made out of the turnover of the entire sector. So not just of the export, but of their overall turnover. As you can see, some sectors in some countries are very sensitive, and sadly, there is a certain overlap between the most vulnerable sectors and the ones that are seemingly targeted. So if we start by the ones that we've already seen implemented, metals was not the most vulnerable, but it is, generally speaking, in the redder one. And as you can see, Sweden was actually one of the most sensitive ones to this, with a large part of the metals turnover being exported to the US. Automotive sector is a very sensitive one in Europe. As you can see, you'd have countries such as Germany, Italy, very sensitive to this, very sensitive to export to the US. But Sweden is also one of these cases in which a lot part of their automotive exports do go to the US. So it's one of the sectors that is most sensitive to this. We also have some of the potential ones here. Again, these are more focused on the sectorial ones. Agri-food, so that's beverages and food. It's more France and Italy. Sweden here comes up as a higher one, but I think we'd be honest to say the beverage sector in Sweden is not the biggest one ever. Pharmaceutical and chemical products are very important industries, and as you can see, both Norway and Sweden, along with Germany and Italy, see a lot part of their export going towards the US. I know some people might be surprised to not see Denmark here, but it's more varied where they ship their goods to, and the concentration in some of the other countries is a lot bigger than it is there. Other examples is so this would be semiconductors, but we could also see other electronics. So that's the third lowest ones here. Another sector that is very vulnerable, one that hasn't been mentioned, but we still do believe is at risk, is general machinery. So this is one of those harder to define, maybe less salient sectors, but ones where usually European manufacturers, in particular Nordic manufacturers, are very good, creating machinery that sort of works into other manufacturing and construction. And it's one where you can easily see tariffs be implemented because there usually is some sort of domestic alternative. It hasn't been highlighted yet, but it is one where we could potentially see some tariffs. As you can see, that one would be very sensitive across the board in the Nordics. What we've seen for tariffs so far is that the impact on the aluminium and steel tariffs have so far resulted more in higher prices. We have seen some improvements in sentiment that we don't really see justified in either the US or in Europe. But there seems to be some optimism within the sector that we can't really 100% stand behind if you look at a macro outlook. But optimism is always a nice thing, so I won't go against that. But so far, we will say that what we're seeing is an impact on prices. And looking at the last time the similar tariffs were introduced, we did see a small impact on domestic production in the US, especially for aluminium. However, the impact was quite small, and I will say the overall trend wasn't changed. For aluminium, it is still coming down, and for steel, it's more or less stable. So the impact of these were not necessarily more production, but only higher prices. Lastly, which Pekka again did allude to, is what are we seeing in German fiscal policy? I just wanted to sort of highlight, the size of this and when we do think the impact will be. The special fund for infrastructure and climate, which was the big number, the 500 billion euros, it is implemented over 12 years. So keep that in mind. It is still a massive fund, and it is very much a change here. But it is over 12 years. This is to be invested. It is true that the defense and security spending, if something goes above 1% nominal GDP, it's excluded. So big investment will completely be excluded, and the only thing that limits is political will and the financial markets. And lastly, which isn't mentioned as much either, is that the debt break for the federal states was also eased somewhat, which means that it's also easier for the states to implement. So all these are good things. And if you sort of add this all together in a realistic sense, what do we believe they can actually take on of new debt, where it's both politically viable, the financial markets will accept it, we'll probably look at something like 1 to 1.7 trillion over the 12 years period. So that is massive. That is 40% of GDP for 1 year, just to keep that into mind. However, something to keep in mind, again, a bit more caution here, is the fact that the German economy already had a 100 billion fund for defense and security spending over 12 years, in which they weren't using it as quickly as they could have. So again, bureaucracy and finding the good projects, etc., can have an impact of how much is actually invested and how quickly they are. But to be on the positive side, where we think there might be an impact on the short term is on sentiment, and it's just to say business sentiment does matter. It's a key driver of activity. It asks the question, do we want to expand? Do we want to invest? What's the size of our labor force next year? If sentiment improves, that can actually have a real impact. And as we're seeing since this was announced, there is a positive sentiment over the expected activity going forward. And we do believe that can have an impact, even if the more fiscal one will probably be more of a gradual one. I'll quickly skip this one of where we are in the Nordics, but generally just to say that we have more or less seen some improvements in activity across the board. Finland continues to be the outlier here with a bit more stagnation. Norway did see a bit of contraction, but that is to be fair after a strong Q3. But else, I will say the headline is that there is some growth most places, which is also why that we don't expect anything impressive this year, but looking at the Nordics in particular, we do expect to see a bit of recovery. But our global outlook has been revised downwards also in the last month, to be honest, which mainly comes down to a different view of the US economy, which we have seen a downward revision of our GDP forecast from around 2% to 1.5%, which is the fact that the Trump administration is seemingly focusing more on the contractionary parts of their policies as opposed to the expansionary part. So that was the domestic deregulation, the domestic tax cuts are seemingly coming in second gear after the immigration and the tariff policies that we believe in isolation are contractionary. So because of that and the momentum seemingly being slightly slower going into Q1, we do believe the growth coming out of the US will be a bit weaker this year. But this is coming after a lot of years of quite strong growth. This has a big impact on the global economy, which we believe will grow only about 2.4%, which is a very, very low level, the lowest level we've seen for decades if you exclude 2020. So this is quite serious. It is a slowdown, and it's more or less across the board. So the US, we expect a slowdown, a bit of recovery in Japan, but some of the key European countries, we do expect a relatively slow growth. And the UK, as an example, is mainly driven by public spending, not as much on private consumption, although there is a small improvement there. We do still believe, depending on tariffs implemented, that China will be able to produce slightly above 4% GDP growth, which will be below their target, but still be at a relatively high figure compared to where they are in the economy, although definitely undershooting their growth potential. India, we expect, again, this one is very much depending on what tariff implemented, still relatively stable growth there. And in the Nordics, we expect relatively stable growth between 1.4 to 2%. For some of these countries, Finland in particular, and Sweden to a certain degree, this is mainly a recovery as opposed to solid growth, whereas in Norway and Denmark, it's more continuous of a relatively good growth path. But I will say, if someone thinks, wow, that figure coming out of Finland sounds very impressive, it is kind of like what you saw in Japan. After a year, in Finland's case, 2 years of relatively low growth, it is slightly easier to produce impressive figures, simply due to base effects. So the key headlines domestically is that inflation has come down to around the 2% target for most countries. It is still proving sticky, and the outlook going forward is probably that we will see a bit of a reemergence. In most of the countries, we do believe this will still stay around the 2% target. However, as you hopefully know, Norway was a bit of an outlier here, seeing some quite severe inflation figures, which is also why we do believe the inflation numbers will come out slightly higher in Norway, even if it might ease somewhat from this very high uptick. But some of the base effects from energy are ebbing out, which means that will sort of naturally push inflation up in some of the Nordic countries. And again, with the exception of Finland, we are still looking at quite high service inflation in all these countries. And as you can see, Norway in particular, but also Sweden, this is particularly severe. So service inflation, which is quite hard to change, and especially now that you look at some of the collective agreements for wage growth, we do expect that to continue to be relatively high, and that is limiting central banks' ability to cut rates. So our main assumption now is that the ECB is towards the end of their cutting cycle. They will potentially have one more cut in them, potentially even more, but that would kind of depend on a bit more of a downturn in the economy. But else, we do believe they are in a relatively good position, but again, maybe with 1 to 2 cuts going forward. We believe the Sweden central bank, the Riksbank, is more or less done with its cutting cycle. Once again, that's our main scenario. If we're looking at further cuts, it would be due to a downturn. And I know there's some people questioning whether or not we could see a hike there. I don't really think that's very likely. But never say never. But I do still think, looking at sort of the momentum of the economy, I'm not really sure that would make much sense. For the US, and I'll mention that one before mentioning Norgesbanken, we do expect there to be a bit of a potential rate cut. However, to be honest, it's a difficult one, because so much of it will depend on how the economy develops and how severe the tariffs are. So there's a lot of unknowns there. It's a bit of a hard outlook. I still say our main scenario is that we probably will see 1, potentially 2 cuts, but a lot of that will depend on how tariffs are implemented and how much they impact economic activity in the first half of the year, if that opens the door for potentially cutting. For Norges Banken as the last one, we do expect them to maybe do one cut this year, but I will say with the sort of relatively stable GDP figures and employment figures, but also quite high inflation figures, they are quite limited, which means it's difficult for them. I still will say that potentially one cut is possible. That's also what they are so far indicating, but they are in a difficult position from a cutting point of view. We have seen some improvements from the Swedish and Norwegian crown compared to in particular the euro. I do expect them to be in a slightly better position than last year. I will say some of the very strong improvements of the Swedish crown I do think might be slightly optimistic, and we will see a bit of reversal of this trend, as I do think there's a lot of positive things that have really caused this improvement that I'm not sure are really sustainable for the rest of the year. But we have seen some improvements for both the Swedish and Norwegian crown. Before moving on to insolvency, I just want to highlight that lastly, the financial conditions are improving, but interest rates are still high for corporates. They're a lot higher than they were before. That continues to be true. We're not looking at policy rates going back to what they were, which means that companies will have to get used to this higher level. And as you can see, that does mean that the companies are more or less across the board dealing with higher interest coverage ratios. So a bigger part of their revenue is going to honoring their debt. And while we have seen some improvements, as you can see, we are still in a world in which that is quite a bit worse than it was before the pandemic. So the good, the bad, and the ugly, because I also wanted to add the positives here. We are looking at a higher domestic real disposable income. That is more or less true across the board. We are helped by some tax cuts in Sweden. There is an election in Norway coming in September that we do believe also could improve some sentiments. We don't know what the policies will be, but given how strong the economy is, we could either look at improved government spending or potentially some tax cuts there, which would again support the economy, and the Norwegian economy can afford to do both of those two, or either. So sort of some of the two good ones is on domestic levels, with the exception of maybe Finland. On the government spending part, we are across the board seeing better disposable income, higher government spending. Caveat is Finland. However, on the bad side, on the domestic levels, I already mentioned the interest costs element, but we're also looking at quite higher operational costs, continues to be true, high energy prices, high labor costs. And then the ugly is the one I've really been speaking a lot about, which is the trade uncertainty and the European manufacturing sector that is very important to Nordic manufacturers. That is still lackluster at best. So 2025 is a year that has some positives, and we want to highlight those, but there is a challenging environment as well, and companies are fighting to maintain their margins. Because of this, we are also still seeing relatively high insolvencies, particularly in Sweden and in Finland, that continue to be elevated, whereas they are still somewhat normalized in Denmark and Norway, even if they continue to be gradually rising in Norway. I'll stop here, and I'll be able to send these slides on a sectorial basis to you guys of what we're seeing with insolvencies, but I'll let on to Arnfinn. You are muted, Arnfinn.
I'm on now, I think.
Yes.
So, thanks for an excellent macro review, Jonathan. I'm now going to talk about details from the risk underwriting perspective, but first I would just touch upon my recent visit to Boston, the seafood conference there 2 weeks ago. And when you follow the news in Europe and Nordics, you should expect Europeans to be treated like a persona non grata when entering the US. But I've been there many times, but this time the immigration was as never as smooth. Being part of industry talks among European suppliers and importers in the US, my view from the conference was that it was very high activity and it was very, very positive sentiment. However, tariffs would give some short-term disruptions. From the seafood perspective, when navigating the current geopolitical environment from the conference, I got the three main key takeaways: that the current environment with uncertainty and negative news is a historically repetitive situation seen many, many times before. And central banks will eventually balance politics. And with the Fed now easing and stopping the rate cuts, they will probably look at how the tariffs will have effects going forward. And for seafood in particular, this sector in the US has a very, very strong market trend. So if you have the longer term glasses on, markets will rebalance and stabilize. However, mostly the consumer will pay for the tariffs. But for the shorter term, we expect disruptions in markets, and tomorrow will be a very, very important day. And I expect that we will see a very, very much news, and I guess it will be very, very difficult to miss that. So be prepared, but breathe with the belly. So then I will enter into some reflections from the risk underwriting sector in these uncertain times. And in uncertainty, we expect credit quality to deteriorate. And as insurers, we always look at the portfolio first and review risk sector-wise. For the steel and metals industry, we have already done an assessment after the tariffs were announced from US, including each local COFAS office around the world. Bringing these sector reviews further, we look at each company's sensitivity to markets with tariffs. We see if there are markets or regulatory state adjustments, like for the metal sector, where EU has communicated this steel metals action plan to safeguard the industry's future, as this is crucial for guaranteeing security for EU. We also look at the footprint of the company, as these may have differentiated structure and production capacity within tariff-fenced markets. When we see tariff imposed, we expect some value chains to adapt and products may change routes. Some sectors may adapt fast, some slow, and we see comments that this give higher costs and investments. We also expect to see implications for seaborne trade if US impose port tariffs on Chinese vessels, eventually increasing import prices. Looking into companies' financial performance, eventually pricing of products will be an issue, and to understand the sensitivity of the demand relative to price will, of course, be very important. Like a 200% tariff on European wines will have significant effect on demand, while 25% on less sensitive products may not change demand significantly. We have seen price jump due to supply issues lately and seen normalization during COVID. And this has mostly adapted and normalized, as we see when we read financial statements for 2023. Then it's more normal figures. We expect potential tariffs to be shown in the US PPI shortly, and will monitor this closely. Increased costs will put pressure on margins, in particular short-term and liquidity, as we know importers have to place guarantees for tariffs, which will put pressure on available liquidity, as we expect pricing to lag the cost increase. Some argue that tariffs will also hit CPI and inflation, and this will give rate hikes and trigger additional interest costs. This, however, may be altered by reduction of taxes, so uncertainty to a final result. A company's sensitivity to the US market will be important to monitor, and if sales volumes will be rerouted to other geographies as that is non-tariff. So we will be in close contact with exposed debtors to be able to access updated financials and monitor development continuously. Eventually, the increased cost will be shown in payment trends and bankruptcies. And actually, we've seen some negative signs in the US and Canada already, and will monitor closely with our colleagues in the US. So sort of to be updated on real companies' actions, we do follow listed companies as these need to comment on larger risks to their investors. As the metal sector was one of the first sector with tariffs, I compiled some recent statements here from larger metal companies in the Nordics. Most of the companies are continuously taking actions, and some has investments in the US balancing the risks. So I just had some quotes from the companies, the larger ones. And I have from Outokumpu, the Finnish steel company, which actually has capacity in the US and Mexico. And their message to the investor was that they see increased risk. They have like a differentiated production and still sees growth in the US. SSAB, the Swedish steel company, also has production capacity in the US, and they say that demand is positive with higher shipments, and they see lower price and has no negative assessment yet. Elkem, which is a Norwegian-based metal company within silicon products, they also have production capacity in the US, and they say that their business model is well positioned for global tensions. And then I mentioned also a Norwegian company, Hydro, that also has plants in the US then within extrusion. And they, in the extrusion market, they actually see price hikes, but however, limited impacts to Hydro. And then Alcoa, a US company with production capacity in Norway, says they are well positioned globally to respond to changing dynamics. So all the larger metal companies have strategies to mitigate the risk, and most of them has already a differentiated business model with production capacity within several countries and also within the tariff areas. So since tariffs were introduced, there has been no significant negative event. However, as I read the statements, they have put investments on hold. So it could have some impacts in the value chains. So from a risk underwriting perspective, to sum up, the future and especially the short-term future is uncertain. And of course, with uncertainty, the credit quality in general deteriorates. So our actions on a daily basis will be that we monitor the tariff policies and try to use industry associations to have their view on their companies. And we try to get as recent financial statements as possible to assess financial impacts on sectors and especially focus on corporate margins and how the operating results can cover interest rates. We also look at the financial strength, reviewing the strength in liquidity especially, and also working capital to cover if value chain changes or if there are high gearing in the balance sheet. We will also react on negative payment info. And we've recently, as I mentioned before, seen more activity in claims in the US and Canada. So in the end, tariffs can be imposed only for a short period of time. So let's see the next step tomorrow. So I hope this session gave you some input to review your own credit risk when entering into future contracts. And then I pass on to Mona for further discussions.
Well, thank you, Arnfinn, and thank you to all our speakers for your insights. And that concludes our presentations. So then we will move over to the Q&A session. And now it's the time for you to ask your questions, and you can ask everything from the macroeconomic picture to how these trends will affect credit risks and decision making. I see no questions yet, but I know for sure that Jonathan, he has a question for Arnfinn to get us started.
Yeah, so I alluded to the Norwegian election as an impact on domestic demand, but I know that there is potentially some discussions here around the EU, closeness to the EU, not necessarily become a member, but potentially moving a bit closer. Well, what is your impression as a Norwegian there? Do you think there is a bit of a change, and maybe not the short term, but sort of the medium term on maybe moving closer to the EU from a Norwegian point of view?
Yeah, looking at the news and so on, I think the sentiment after we have seen more uncertainty about the NATO, especially going forward with all the geopolitics, I think the sentiment has moved to more positive view on EU, and I can probably only see one political party arguing for not. And they are currently very low in the rating polls. So I think at these times it's more a positive sentiment for EU. And for business in particular, EU is the most important export market. So I think it's also very important to have good relationships with EU. And I think also currently with the tariffs and being in the middle, not in the EU, and also having that the US has a surplus in terms of trade to Norway. We need to have, of course, good connections with both parties, but I think we are more close to EU and than the US going forward.
Perfect.
All right. Talking about elections, Jonathan, I have a question to you. If we don't have anything in the chat, what about
We have
Finland?
we have something in the chat here, Pekka.
Oh, fantastic! Let's take those first. Good.
Yeah. So here we have a question that says, what will be the impact of tariffs on the service sector?
Oh well, so directly nothing. So that's again the beautiful thing that Trump keeps on overlooking is that if you look at the trade deficit they have, he's only focusing on goods here. If you look at services, the US have a massive surplus. So he's very selective in where he thinks there are some weaknesses. So it's very hard to tariff services, which is also why that something like the EU digital tax is some of the closest we get to someone trying to tax services, because it is very hard to do. If you usually try to do it, then in theory you can set up a subsidiary, say they did the work, and then have some internal bookkeeping making sure that that's what it'll look like. It's far easier to tariff something. It arrives at the border. Here's a tariff. So on the service sector, directly no impact. Indirectly, that's more the question. If you are a retailer who import goods, then technically there's nothing on the domestic retail level that is impacted. But if some of the things you import are tariffs, then there's an indirect tariffs coming in there. We are also looking at potentially the EU saying they might want to focus more on trying to indirectly tariff services from the US. And if we start such a trade war, that could have some bigger impact. So I'd say there's a smaller impact on services. There's not necessarily a direct impact, but there can still be some indirect impact that you need to keep in mind.
Thank you, Jonathan. And then we have more questions here. So for how long a period do you expect the trade tariffs to be applied?
It really depends. So if we look at something like the steel and aluminium tariff last time, it stayed. And again, our main assumption is there is in particular some sectors that Trump does believe are sensitive, and he would want to keep them on them. So you can probably find a few of these in which, in his eyes, as long as he can keep them there, he'll maintain them there. I could see some of these maybe more reciprocal ones being more of a bargaining chip. But again, I will say I think fundamentally, as long as he's president, some of these tariffs they're to stay, because he fundamentally believes there is an unfairness here, and he wants to make sure that there's more domestic production and more resilience. So some of them maybe more bargaining chips. That could be some of these reciprocal ones introduced. But if you're looking at something like steel and aluminium, potentially even something like automotive, there might be a change in period, but I do think fundamentally he would want to work his way towards a 25% across the board. We could potentially see some small things, but I think in his ideal world, that one's there to stay.
Thank you. And then I move on. So there is a question here. Can you comment on the political situation in France? Le Pen is out.
I'll try not to offend any of our French colleagues. No, I think it's a difficult one. It's a difficult one. I think France, this will probably lead to more disagreement, which means on the very short term, there might be more hesitancy towards the current government, the current prime minister. That means they could very easily have another round of elections, which means there'll be even less happening in France on the short term, because it's not just Le Pen's party, the RN, there is against this. There are several other parties that say this is not how it should be done. So this might lead to more discontent towards the current government, even though, again, this has nothing to do with them. It was a court decision, but that can still lead to some discontent on the short term. On the medium terms towards the election, I do believe this will fuel some discontent. That's what we saw in the US when they were trying to basically ensure through the courts that Trump wouldn't be able to run again. I don't think that is very well received by the public, especially the people who usually vote anti-establishment. If there's a higher tendency of someone voting anti-establishment and the establishment saying your candidate can't run, you're just really reaffirmed that the establishment is against us. So in that way, I could see this potentially helping them, even if Le Pen, and again, there is a question of whether or not she'll be able to appeal this. Well, she definitely will try to appeal it, but whether or not that'll be possible. Also keep in mind that her the next in line is this very young, charismatic politician who doesn't poll as well, but he still polls relatively well. So they might still be able to do pretty well at an election, even if Le Pen is not allowed to run. So I think in isolation, I don't think it's a good thing. I think it will increase the likelihood of a new election in France, and it probably will in isolation maybe help the party's chance of winning in the next election. So no, I don't think it's in isolation necessarily a good thing.
Okay, thank you, Jonathan. We still have a few more questions in the chat, but I think we will answer you in written feedback later on. And if you have more questions to us, you can ask them at nordics@cofast.com. And we are at 10:30, so thank you again to our speakers. Thank you to our audience who have followed us today. And if you would like more financial updates from Kofas, please just follow us on LinkedIn. And thanks again, and have a nice day, and see you soon. Bye.
Thank you so much.
Thank you.
Thank
Bye
you.
bye.
Bye bye.